Um, this is kind of a special session. We normally do these not at the chapter level. We do them sort of at the national level, and we've worked closely. We like to work closely with the Evergreen chapter, so this is a little bit of an exclusive session for everyone, and hopefully that will maybe make it a little bit more interactive. Terry has control of the muting, but this is a case with a relatively small group of us that we can even unmute some microphones and ask questions, have a little bit of dialogue that way, so she'll have to control that.
If you look up at the top of the control panel, you'll see that there's a little circle that's a microphone, an old-timey kind of microphone, and it's probably orange right now. You can click on that and unmute yourself or mute yourself, and we'd recommend that you stay muted during the session. So I can see Jason's is open. We recommend staying muted, but if you have a question, you can always click on that and you'll have audio.
Yeah, so you can use the chat box, or again, since it's a small group, anytime you have a question, you can chime in, and we're happy to do this. That's one of the reasons we're kind of doing this as a little bit of an experiment, just to see how these smaller group webinars work. So that's number one. Number two, we're doing also with the Evergreen chapter, the first time, we're going to do a little bit of an experimental session next week on the 19th at 1 p.m. your time. We're going to do a little bit of a food and beverage roundtable. We have a lot of folks out there that sort of chime in when different people are, out polling for different data, and we know there's some challenges with some of the clubs going on in the Evergreen chapter right now around, boards getting stuck on food and beverage, and why can't we make money with a restaurant and things like that. So we're going to have a special roundtable, and it's going to be an open mic. So we're hoping for 6-8 people to come in, and we're going to deep dive into food and beverage a little bit, not as a presentation, but as a roundtable. And I really want it to be a free-flowing discussion around how do we talk to boards around what the role of food and beverage in a club, and how do we get them less focused on it as a financial driver in the club, which we all know it really isn't, and more focused on an amenity in the club. And we're not playing religious ideology around that. We're using the data to help us all understand that a little better and keep clubs on the right track relative to food and beverage. So that's on the 19th at 1 p.m. I know Susan sent out some emails around that, so hopefully some of you folks will join in for that, and others. And the third part of this is at the end of the session, there are some rules and regs from CMAA around people getting credit for these. This is a 1-hour credit with CMAA that you'll get for this. And on the last slide, sorry for this, but there is a code word that you'll have to email back to Susan just for her to have the record keeping she needs to give the activity credit around this session. So with all that housekeeping aside, today we're going to talk about value creation in clubs. Now, that's a big topic, and it's a bigger topic than you can cover in 45 or 50 minutes, but it's a critical topic because as the nature of what we do in club benchmarking and over the last 7 years, we kind of get smarter and smarter as we go, and now we've seen thousands of clubs worth of data, and we've visited hundreds of clubs. And in that process, we see patterns, and you start to sort of form understanding around the patterns of the finances and the data, and the patterns of what you actually see in the club or in the discussions in the boardroom. And the notions of value creation is one of those, and it sort of lives at the intersection of culture and investment and finances and all those things. And so we're going to kind of roll around on that for a little while. Some of this is going to be art, and some of this is going to be science. There's data behind this, and there's sort of extrapolation around this. But I think it's interesting because ultimately I am 100% believer that clubs that are focused on value creation, literally talk about creating value and creating things that have that create demand for memberships, have a much higher probability of actually doing that and achieving success than clubs that don't and are stuck in the minutia. So we're going to kind of roll around on this, and value creation is a big topic, and so we're going to talk a little bit about what does it mean, can it be measured, If you are there, how do you stay there? If you're not there, how do you, what are the things you can do to try to get there? It's not a flip of a switch, right? You don't say one day we're focused on, something else, and the next day we're focused on value creation. This is a bit of a learning process, and it's an education process probably more than anything. And I think it's in obviously the best interest of general managers and the staff of the club. It's in the best interest of the membership and the best interest in the longevity of the club to have a focus on value creation. Ultimately, I was in a session a couple years ago, and this talked about the changing demographics and how the competition for time of people and families is changing so much, and this is really about how do you keep your club relevant, right? Relevancy and value kind of go hand in hand. If you're irrelevant, you're obviously not delivering value. If you're highly relevant, you're delivering great value, and there's a whole notion around that we're going to talk about. Just as a place to start, we have a few starting thoughts to bring into this. One is, we've thought for quite some time, and I think most people probably, resonate with this fairly easily, but, there are some basic measures that you can use at a very front-end facade of a club, and we think that a club's initiation fee is really an excellent proxy for its own, its confidence in its own value proposition. We all know clubs that on one end of the spectrum have a zero initiation fee, and clubs on the other end have a $200,000 or $300,000 initiation fee. And that's a really, like any product in the marketplace, that's an advertisement, if you will, for the value proposition of that club. If you're a club that has a zero initiation fee, you're kind of putting it out there of, hey, anybody that can steam up a mirror, you're pretty much welcome as long as you can stroke the dues check. Flip side, obviously, is folks with high initiation fees. So we're going to, that's a starting thought. The second is, people have heard us talk about this on and off for a while now, but is the notion of capital-rich versus capital-starved clubs. And that actually has a real financial meaning, but there's a very, very direct correlation between where you sit on that spectrum and how focused you likely are on value creation versus what we'll talk about in a few minutes on the flip side of value creation. So that's important, and there is a way to measure, frankly, whether you're a capital-rich or capital-starved club. We've been doing it with our members for years, but we're going to show you things even if you're not a member, you can take away. It is forward-looking. Clubs that are focused on value creation, they're always thinking about what's next, what's coming a year, 2 years, 3 years down the road, where are we going? The clubs that don't have that foresight, they tend to be thinking about, crap, the HVAC system just went. Where are we going to come up with the money for that? It's a much more short-sighted view. Like any organization, one that is financially sound has their headlights down the road. One that is financially weak tends to have their headlights right, looking right in front of them. So that's an important notion, and it is cultural. I mean, we've got clubs we deal with literally where the membership, because they've seen through experience in the club that monies invested by the club create value for members, that they literally ask them, hey, what's coming down the road, right? Literally, I've had one club, the manager say to me, I have my members coming up to me saying, when's my next assessment? Because I know whatever you guys do with that money is going to be great. That is the best example I can think of how it's cultural versus a culture of, they don't want to spend anything, and there is no confidence in the club's ability to invest member money to the benefit of the member. So again, those things take time. You don't develop that high value culture in a day, and you don't get out of the low value culture in a day. These things are long time coming in both directions. So as I mentioned, we visit many clubs every year, and we see patterns. And as we look at clubs that tend to be value-oriented and clubs, the bookend, the other side of the spectrum that I use on a value creation culture is one of cost-cutting. And so let's take a few minutes and talk about clubs that sit in those two spectrums. this isn't, again, an exact science, but this is pattern recognition. And when we see a club that is, clearly hitting it out of the park, and it's had this multi-year track record of hitting it out of the park, there are attributes that we see around those clubs. And the first one is that they tend to have a strong dues engine. Now, what does that mean? That means they've, for that period, they've had a healthy, vibrant member count, and they continuously, have a level of dues revenue that lets them completely afford all the amenities and expenditures that they make. So it's the clubs that tend to say, well, we're worried that if we have a dues increase, members are going to leave. That's, again, one end of the spectrum. The other end is, no, we have a 3% dues increase every year, and that's just how we do it. The second one is kind of self-evident, but, capital rich. The value creation clubs tend to be capital rich. Obviously, you need, capital to have that notion. But one that's maybe more tactical, but I think it's very telling, is, does the club tend to think of food and beverage as an amenity or as a profit center? And it's very consistent that the clubs that are healthy, vibrant, value-oriented tend to view F&B as an amenity. You would think it wouldn't really be related, but they're not trying to drive profit out of F&B. They're not saying, boy, we need more banquets, more banquets. And so that's kind of a trigger warning around whether you're on this side of the spectrum or the side we'll talk about in a minute. There is this notion of rising expectations. The membership wants to know what's coming next, right? They view the club as a growing facet in their life, whether it's for them personally or for their kids growing up or their family, whatever it is. But there's an expectation of what's coming. Which, of course, is another way of saying they're focused on the future, right? It's not just what the club does for me today, but it's this. The club is a long-standing entity, and the family's membership in the club is a long-standing relationship, right? That those two things go hand in hand, and cost efficiency is kind of motherhood and apple pie. On the flip side of that, you have, and I'm taking a little bit of time on this chart. I apologize, but it is a good sort of. I think probably everyone listening can sort of place themselves, if not in one or the other, absolutely, certainly we lean towards one or the other. And I think it is a nice framing way to look at a starting point. These clubs that are financially less healthy, they tend to have a cost-cutting culture. It's not around what could we do, it's how are we going to do what we have to do. They tend to have weaker dues engines. Maybe they've been losing members, might be a tough demographic area. Might be that they're afraid to raise dues. They tend to be capital starved. That can either be because a weak dues engine, frankly, creates an operational deficit and they end up stealing their capital, or it may be that they organically don't have enough capital income. Maybe they're one of those zero initiation fee clubs and they don't have a capital dues in place. If you're a very low zero initiation fee club and you have a weak or no capital dues structure in place, you're pretty much guaranteed to remain in the capital-starved state, which means you're probably going to remain in a cost-cutting environment. I talked about F&B. They view it as a profit center. It's, why can't we run like a restaurant? How come our cost of food went from 42 to 43%? It's those kind of crazy discussions that really aren't about value. And they tend to think of, what's the least we can do and keep people just happy enough not to leave. So it's a diminishing expectation, not a rising expectation. And it's a very short-term focus. So, hopefully on the call, more folks resonate with the left side than the right side. But, the reality of this industry is there's a lot of clubs, especially smaller clubs, that are a little more struggling at this stage, that sit over on this side. Now, again, before we get into the numbers, this is I think, an important philosophical notion. It's not. I think it's more than philosophical. It's grounded in reality. But again, bookend, because it's easy to sort of understand it that way. We view that from a capital investment thesis, and we do view the ability to invest capital with the likelihood of whether you have an opportunity to be in the growth cycle or whether you're going to be resigned to the decay cycle. But clubs that are in this cost-cutting decay cycle mode, what are those? What does that vicious circle tend to look like? It tends to have restricted capital investment, meaning you're capital starved. What does that do? We've all walked in the door, or sometimes all you have to do is drive into the parking lot and you see the potholes in the parking lot. But we've all visited clubs that when we walk through the door, we think this club probably doesn't have enough money to replace these aging assets that I'm looking at, or get new furniture or new carpets. So you've got really a narrowing of amenity sets and deteriorating facilities. This is a supply and demand game. Ultimately, the services and amenities of the club are the product, and if you've got deterioration of those, you're going to fundamentally have higher attrition rates and lower demand from prospective members. So this is really where the marketplace speaks in a restricted capital investment environment, in that you've got lower member satisfaction than you'd like, and you've got lower demand from prospective members. Well, what does that do? Of course, if you've got that, you've got, by definition, lower initiation fees and fewer members paying capital dues, and decreased capital income. So it's a very challenging cycle to get out of once you're in it. On the flip side, the happy place to be is you've got a club that isn't capital starved. It doesn't necessarily have to be capital rich, but let's just call it capital adequate. And this is kind of the on-ramp. I view this as the on-ramp into this cycle, which is some capital investment that starts you down the path of broader amenities and facilities, which, frankly, those amenities and facilities ought to be geared towards member satisfaction and member value. If that's the case, anytime, one of the things we look at is anytime a club does a significant capital project, they should be asking themselves the question, does this allow us to increase our initiation fee? And if the answer is no, you might actually want to circle back and say, is this project really geared towards a higher value proposition? So ultimately, that investment should be driving the ability to increase demand from current members, as well as increased demand of prospective members, which in turn forces higher initiation fees and more members coming in, and hopefully you've got a capital dues in place to put predictability into your capital income, and so you drive increased capital income, and you stay on this cycle. And literally, we've got a high number of clubs that now, again, in recognizing this pattern, we see every 2 or 3 years they're doing something significant. And the value of that isn't just when that project is completed and people can use it. Quite often the buzz is prior to it actually being unveiled, whatever it might be. And when members come through the door, prospective members come through the door, the discussion is what's coming next. And, here's what we have today, but here's what's coming next, right? It's a very positive message. And so it's important to recognize where you are, and it does take bold effort to move from this cycle into this cycle. And our hypothesis is that it really does take capital investment to get you from one to the other. So again, I spent a lot of time on that, but I do think when people see this, there's a lot of clubs we have say, oh, could you send me that chart because I really need to bring that into the boardroom. Because this is a very business-like view, right? And so ultimately what we're talking about in any business, not just the club business, but it's investing your way to health, not cutting your way to health. There's no point in time that you've cut your expenses back far enough where you say, oh, we did it. Now we're healthy enough and we can move over to here. That's not kind of the way it works. It's usually what is it that we're lacking, what would drive demand for current and prospective members, and taking that leap. So, people that work with us know that we take a very business-oriented view of clubs. We borrow, frankly, a lot. We steal and borrow a lot from the normal business community of how do we measure and evaluate health, financial health, and investment, value. So one of the notions, for a second, is this notion of return on investment. I'm just going to spend 1 minute on this, if at most. And so ROI, as we all know, is basically what's the return that a company makes on a specific investment. And that's the way companies in the real world decide, do we do A or do we do B? well, which one, based on the investment, is going to give us the higher, return on that investment? Clubs generally don't think this way. But ultimately, I'm not talking about an investment like, replacing a carpet or replacing an air conditioning unit or things like that. I'm talking about real value-add capital investments, major projects. And, ultimately, in the business world, projects either, return higher profit or decrease expense or both. And the club world isn't quite that cut and dried, but the same notions do apply. Getting it probably to where it gets a little more play, a little more analogous to the way clubs can measure themselves, and we're going to go through this specifically for clubs, is the notion of return on equity. And so in the business world, return on equity is a term that's used nearly every day. And essentially, it's the notion of, ultimately capital is deployed to managers. That manager is going to invest that capital in some type of product or service, and the board of directors or shareholders, expect some kind of return on that deployed capital. So ultimately, return on equity is the annual profit made from delivering a product or service in proportion to the equity invested in the business that year, as an aggregate. Now, in the business world, right, we use terms like profit and shareholder equity. Right? So return on equity is the profit divided by the owner's equity. In the club world, it's not quite that easy because operationally we tend to be around break even. So even though we've made a big investment, we don't see that as an operational profit. But we're going to talk about in a minute how there is a way to still measure it, because as we just talked about, when you make significant investment, you should see a return through higher capital income. So that's where we're going to talk about. We're going to play out that theory as we go through it. Now, if we look at other industries, because we do like to look at other industries and see how does that correspond to maybe how the club industry can think of themselves, you've got a whole range of return on equities for different industries. Everything from 6% ROE in commodity type companies, all the way up to 20 plus. Right? You've got Amazons and Googles out in your neck of the woods, and their shareholders are going to demand return on equity up in these ranges, and the reason is there's higher risk in the capital that they invest. Right? They're doing bold investments on things that have high potential return. If you're in the copper mining business, basically there's only one thing that your business depends on. What's the GDP growth rate in the country or in the globally? And you're going to just follow that because everything else is understood about that business. You're just digging out dirt and pulling the copper out of it. So, low risk, the way investment works, low risk demands low return, and high risk demands high return. And so we're going to go through at the end of this, towards the end, and we're going to see where does the club world fit in this, and the notion of capital-starved versus capital-rich clubs. How does that return on equity look, given that can be a proxy for a club's not only ability to invest to generate value, but its success in those investments. So I've gone through this a little bit, but part of the reason that we use business terms to analyze clubs is because it works, and some of the standard like things like gross margin and things you've seen us talk about, and labor ratios, they're just as relevant in clubs as anywhere else. But at the same time, board members are by and large business people. And so when you start using these business terms with them, they get it, right? They understand return on equity. They may not understand how it applies to clubs yet, and that's what we're going to talk about. But ultimately, return on investment in clubs is driven by increased capital income. And so just a very quick story on that as an example of a club that didn't have that notion in mind. This was a club, I won't say obviously what club it was, and it was a beautiful club. It was on a waterway in the southern part of the United States, and it was having some problems with member retention and drawing new members. And they kind of had one shot at doing some major investment. And when you walked into the club, it frankly all looked a little bit tired. The member area looked a little bit tired, member dining, and the banquet area looked a little bit tired. This was about 6 years ago. And they had someone come in and frankly led them down a path which wasn't all that fruitful, which was, spend $3 or $4 or $5 million on the banquet area because you'll drive in all this banquet business and that's going to generate all this incremental revenue for you, and you've all sort of probably heard variations of that story. Fast forward 3, 4, 5 years later, we all know that food and beverage, even if you have lots of business, doesn't return a lot of margin, and so it didn't really change the financial state of the club at all. All it did was put it in about $5 million worth of debt that now it was shoveling through. But meanwhile, the member area still had a 1980s look to it, and if prospective members walk in and the husband and wife are looking at it, it's like it's okay. If they had put the thought about are we investing in member value, they probably would have redone that whole area, and it would have been spectacular. And now you bring husband and wife come through the door, and they think, wow, I want to eat here 3 times a week. This is beautiful. Saturday night, fantastic. And so that was a club that they had the right idea, and you have to invest your way to health, but they weren't wise in their investment. So there's two aspects to going at value creation. One is the ability to invest, and we're going to talk about that more in a minute. But the second is a little bit of discipline on the investment, and that everybody looks at it and says, this is of member value, right? It's a member club, and it has to be such that when the project's done, any current member or any prospective member walks in and says, that's fantastic, that's a plus for me as being a member of this club. I'm not going to go through this, but there's a notion of people have heard us talk about net available capital. It's the way we measure whether clubs are capital rich or capital starved. And frankly, all it is it's all of your capital income plus or minus your operating result, right? If you have a deficit, you steal your capital. So all your capital income plus or minus your operating result less your lease expenses. And every club at the end of the year, we do it for every club, but you pile up your pile of cash that's available either for capital investment, for debt reduction, because sometimes capital-rich clubs, they'll borrow the money, but they're capital-rich, so they use that as the ability to pay back debt. That's just a choice of how you fund something. Or you can frankly put that money in the bank, or any combination of those. And what we've seen now over 6 or 7 years is that clubs should be operating in a zone of about 12 to 15% of operating revenue as a net available capital number year over year. So what does that mean? If you're we'll use easy math. If you're a $10 million club, net of operations, net of capital income, and net of those lease expenses, you will have piled up about $1.2, $1.4 million that can be, either spent on capital investment, debt reduction, or increasing reserves. And that's a year in, year out. Right? That's a number that we've now consistently seen in clubs that perform well and are able to stay on that green, growth investment wheel. It doesn't say that all that capital is sufficient to do major new projects. You might still have to go out and have debt and or do an assessment or something like that for something major. But it puts the asset replacement in good stead, so that you're reacting to end of life and your normal asset replacement. You're able to fund that stuff completely without concern, so you're able to look down the road at the big stuff. If you've got a 3 or 4% net available capital, your depreciation is likely 2 or 3 times that. So you're literally shrinking as a club, and we're going to look at clubs like that. Here's capital-rich clubs, or the net available capital ratio. And on one side, we've got the capital-rich clubs, and the other side, we've got the capital-starved clubs. And this really is, half of the equation is, do I have the ability to keep my club at least in a discussion around, we're healthy, we're vibrant, we can replace assets as they need to be replaced, let's look down the road. And it's amazing to see the consistency. Capital-rich clubs tend to stay as capital-rich clubs, and capital-starved clubs tend to just survive as capital-starved clubs, and you can see there's a few that are really low, below zero here. That means they stole all their capital and they still can't pay their operational bills, and that's a very, very bad place to be. And of course, there are lots of clubs in the middle of that. So this next chart, all we did was we blow up this part of the curve and we blow up this part of the curve and look at it a little bit more closely. But it becomes fairly obvious that the capital-starved clubs half of them have, literally no capital to invest, and the capital-rich clubs, the median of those, they've got 20% of their revenue is left over. The number isn't from operating revenue, but as a number, if that was that $10 million club, that's $2.2 million that they have left over. Now that's not typical, but we're trying to convey notions of this is all about, A, you want to know where you are in the cycle of capital rich versus capital starved, and B, are you moving in the right direction, right? We're big believers that every club should strive to be a capital rich club so that you can have the discussions around value creation. Obviously, it's fairly self-evident, but capital rich clubs, when you look at how much they actually do invest, capital rich clubs invest about twice as much, not as a dollar amount, but as a percentage of their revenue, as capital starved clubs do. That's fairly intuitive and obvious, but this ultimately is the start of the investment cycle, is are we investing enough in the club to generate, at least keep the place looking good, and so that when people walk through the door, whether they're a member or a prospect, they perceive value right from the start. So, why is it that some clubs are capital rich and some are capital starved? What are some of the attributes? And we've talked about some already, but just some data points. If you look at initiation fee, capital rich clubs have initiation fees well over 2 times the initiation fees of capital starved clubs. Probably not a surprise, right? This whole discussion is wrought with the chicken and egg syndrome, right? Which comes first, a higher initiation fee or being capital rich, and vice versa. So, but the important part is, if you're a low initiation fee club, you have to get yourself out of that cycle, and it's the discussion to have of what are the, you can't, one is out of fear, right? I get it. When you have the downturn and initiation fees came down, it gets very hard to get out of that cycle. But ultimately, zero initiation fee clubs have, virtually no chance of getting into the capital-rich, growth cycle. So, we all know the definition of insanity, right? It's doing the same thing and expecting a different outcome. That's kind of how initiation fees play out. So I did an interesting thing a couple weeks ago on a new ratio I looked at. What I simply did was for our database, I took the initiation fee and I divided it by what it costs to be a full member. So initiation fee that a full member pays, and what the annual dues rate is for that full member. And this is a curve of what the industry looks like. Now, we've got, actually it's more than this, because this isn't counting the clubs that have a zero initiation fee. So greater than 25% of the industry has an initiation fee that's less than 1 times the annual dues rate. Wow. That's a pretty low hurdle for culling, frankly, the members that you bring through the front door, and it's a pretty low, from a marketing perspective, it's a pretty low positioning statement to say that, we've got a $2,000 initiation fee or a $1,500 initiation fee. I talked to a club a few weeks ago, and all the clubs in the area have $0 initiation fees, and we were talking about how, and they joined that crowd. They became a $0 initiation fee, and we talked about the whole notion of, being the only club that says, no, ours is $5,000, and the reason it's $5,000 is because we understand we have to invest in the club and, to keep the place looking great, and so there's a positive spin about that. But what they said to me was, no, we did, after 2 years of a zero initiation fee, we changed it. I said, oh, what is it now? It was $750. So, I kind of chuckled a little bit, and I said, honestly, from my perspective, if I'm thinking of myself as a prospective member, at least a $0 initiation fee is kind of a policy thing. When you put a $750 initiation fee on it, you're putting a price tag on the value proposition of the club. So we had a whole discussion around that, and zero is also bad, but when you do that, it's really not any better, and it sort of maybe makes you feel better coming out of that board meeting, but it's not a good message. But in terms of one of the things I try to do in life is I try to surround myself with people that are smarter than me, because I'm hopeful that some of that rubs off on me over time, right? It's like if you play tennis, right? You play tennis with people who are better than you, and so forth. And so if you look at the clubs that live up in this zone, and these are, you've got initiation fees 6, 7, 8 times what member dues is, that's clearly making a pretty bold statement about how they think of their club and what people are willing to pay to be in their club. But let's look at something like turnover ratio, right? We've studied this to death, right? Low initiation fees equal high turnover ratio. High initiation fees equal low turnover ratio. Now, there's a lot of moving parts around that, but again, you're trying to emulate, a direction for your club. Who are the clubs you want to kind of hang out with? What do they look like? And I want to look like one of them. Obviously, member counts, right? Member counts, kind of go the same way. Higher initiation fees, these clubs tend to attract more members. So the whole notion of clubs still do this. They go through the thought process of, we're going to a lower initiation fees because we think that's going to bring us more members. And we have yet to find a club who, when we say, well, how many members did you bring in last year? And they give us a number, and then we lowered it to $0 or to $1,000, and, well, how many did you get this year? And it's usually not any higher. In fact, it's quite often lower than it was in the year they had some kind of rational initiation fee. So, it's not a great marketing tool, because I think people are pretty smart and they see through those things, and it's just important. And then, of course, the net available capital number. Clearly, if your initiation fees are at this low rate, versus at the higher rate, you're going to have an impact of net available capital, again, which is the ability to turn and invest. So we're going to go through, we're not going to worry about this. It's the same notion around the actual initiation fee income. Obviously, capital-rich clubs bring in much more initiation fee than capital-starved clubs. Again, just, and it's important to know, where are we in this spectrum if you don't already know. By the way, I think a number of clubs on here are club benchmarking subscribers. Any of these charts we're looking at, these are just right out of the reports, right out of the database. So if you don't know how to run them, talk to us and we'll help you run them. But this is all stuff that you can get with a click of a button. Another notion of, why some clubs are capital rich and why some clubs are capital starved, or, the simple notion of capital dues. Half the capital starved clubs have no capital dues. 3/4 or more of the capital rich clubs have a capital dues, and they also have a higher capital dues. If you have, your capital needs in a club are highly predictable, right? If you've done a capital reserve study, you know exactly when assets are going to need to be replaced, or maybe they're long past replacement. It's predictable, and so you need your capital income to be predictable. And we all know initiation fees are not predictable; they're lumpy. But capital dues is highly predictable. And so, the notion that the industry has to, get past is members thinking that my capital contribution to the club ends with my initiation fee. It doesn't end with your initiation fee, it starts with your initiation fee. And the capital dues is a great way to reinforce with members, there are 2 things you will forever fund in this club: the operational expenses and the capital investment requirements for this club, and the capital dues. I'm just a big fan, so I tend to go on about that a little bit. But if you don't have a capital dues, it's a very worthy discussion to have in the club. We're gonna blow through that. By the way, in terms of capital income sources, there really are 3 fundamental sources. It's not everybody understands this. Initiation fees tend to be about 1/3 of capital income. Capital dues tends to be about 1/4 of capital income. Assessments are about 1/4, and then you've got operating surplus or other capital income that comes into play, maybe sale of assets or things like that. But it's really the 2 that every club should have in place ongoing. Obviously, are some non-zero initiation fee and some level of capital dues, and then the assessment comes into play on some ad hoc basis, based on some project that you're able to convey to the membership has a high value to the club. We looked at turnover a little bit, but capital-rich clubs have half the turnover of capital-starved clubs, and that's a big deal. I mean, when you think about a 4% versus 8% member turnover, 4% means you have to replace the entire membership every 25 years. 8% means you have to replace the entire membership every 12 years. That's a big difference. And as a, it's like, it's the old keeping a customer. You've heard in every business book ever written, it's cheaper to keep a customer than it is to attract a new customer. It's no different in the club world, and obviously turnover rate is a great, a great measure of that. So, just a few things that we've learned so far. We're going to get back into the return on equity a little bit. But, we know that capital-rich clubs invest a higher proportion of their money, not dollar amount just, but higher proportion of their money back into the club every year. They have more members. I didn't show it, by the way. They have more members, but they aren't more expensive to belong. Beyond the initiation fee, we've done the study. I didn't include the chart here. But the dues rate for capital-rich clubs is no higher than the dues rate for capital-starved clubs. It tends to be, at the median of the industry, around $7,000 a year. But it doesn't cost more to belong once you're in to belong to a capital-rich club. It's a heck of a lot nicer to be a member of a capital-rich club, that's for sure. They have higher initiation fees, higher initiation fee income. They tend to have capital dues, higher capital dues, and more overall capital income, and they have half the turnover. This is a great set of attributes, and when we look at the things that boards focus on versus don't put enough time onto, and we're big believers of let the GM and the staff manage the income statement and let the board manage the balance sheet. All these things are right smack in the middle of board focus and balance sheet, right? Where's our how much capital do we need? When do we need it? Where's it coming from? How do we make sure it comes in year over year, right? How does that discussion compare to how do we get our cost of food from 40 to 39%, right? That's a whole different ballgame. So now we've kind of come through a long path here. But we're going to circle back and say, let's see if we can figure out what the return on equity is in the club world. And not only figure out what it is, but is there a difference in return on equity in capital-rich clubs versus capital-starved clubs? So the equity side in the club world, it's not like a for-profit company where you have shareholders or owners' equity. In the club world, it's in the nonprofit club world. It's called unrestricted net assets. It is a grossly underutilized measure, and we're going to talk more about it. But basically, it's the sum total invested at any one point in time. Any one of you could talk to your CFO, and they could run for you, here's what our unrestricted net asset value is, and more importantly, as we'll look, what is it doing over time? We'll talk about more of that in a minute. Obviously, it's a moving number because your current assets depreciate, and as you bring capital into the club, that boosts your asset base. And can it be tied to member satisfaction? We'll look at that. So here's one of the punchlines. And so, we saw this notion of we'll call it, high value industries or, risk reward industries and low risk reward industries. And let's look at capital starved clubs versus capital rich clubs. And we just took the median of those two kind of groups. And the dollar value of the unrestricted net asset value of the club isn't really that important. It just happens to be a fact that capital-starved clubs have a median net asset value of about $4 million. And capital-rich clubs, now they're bigger, they have a net asset value of about $13 million. Again, the number's not important. We're going to look at some trending in a minute. And then you say, well, what if we buy into the notion that clubs with higher value proposition, based on the wheels we looked at, meaning a nicer set of broader amenities that people value, either current members or prospective members, those clubs generate some level of capital income. Clubs that are capital rich generate some level of capital income, and these are the median values for those. Now, you've almost getting there a little bit slowly, but if we look at the return on equity for capital-starved clubs, you just do the math, right? 214 over 3701, you come up with a 5% return on equity. Capital-rich clubs have a 13% return on equity. So let's just jump over to our industry chart a little bit and say a capital-starved club actually has a return on equity lower than the commodity industry, right? That should sink in for a second, because every club, right, the fear of every club should be, are we turning ourselves into a commodity? Is this club a commodity? Are we marketing ourselves on price? Now let's think back. No initiation fee. We haven't had a dues increase in 5 years, right? No one in the area has initiation fees, but so let's make ourselves cheaper to join than everybody else. That's the definition of commoditization, where there's no value differentiation, and the only differentiation is how much does it cost, right? Lots and lots. The whole world with online buying, everything is becoming commoditized. A club becoming commoditized is a very dangerous thing. Capital-rich clubs, they've got a return on equity that fits somewhere in the, it's not a high-tech, it's not like a Microsoft or an Amazon, but, it's kind of in utilities, consumer goods. It's a very rational return on equity for something that, produces something that people perceive value in. So there's value differentiation and commoditization in this case. So the question is, do you monitor your unrestricted net assets? I would posit, this is a small group, I would guess that there's never been a discussion in any one of the boardrooms of anyone on this call around, is our unrestricted net asset base growing or shrinking over time? It should be increasing. Now, let's look at the example of a capital-rich club. Every one of you can pull this number out of your own systems, and if you are a member, we can, this is a real club out of our system, and we just pulled one of the example capital-rich clubs. This is what's happened to their UNA value over time. It's pretty significant, from 2010 of $18 million to 2015 of $22 million. Now, it's a big club. That happens to be the example of using. But the point is, this curve is up and to the right. The flip side of that is, here's a capital-starved club. And you can see that this is a flat to lower meandering kind of curve. This is a club that doesn't produce enough capital to even replace depreciating assets. So literally, it's consuming itself. If you've got $500,000 of depreciation in a year, and you generated $300,000 of net available capital, you literally shrunk the club's asset base by $200,000. That's why this notion, every board member of every club should have a picture of this curve in mind. Is our asset base growing or shrinking? And it's the application of capital. Hey, it comes from members, right? New members joining, initiation fees, capital assessments and dues from members. Ultimately, that's where the capital comes from to invest, but it should be a self-fulfilling thing, right? And as you grow as you invest in the club, your capital income should be increasing, and that's what would then give you, in fact, a steady state return on equity. And I apologize for getting a little overly business wonky here, but if in fact your asset base is increasing, your capital income should be increasing at a similar rate, and that would keep you at the same return on equity. If in fact, so the club I gave as an example, that club pumped in $5 million. Now it was debt, so but eventually that debt got paid off, and that capital came from the member balance sheet into the club balance sheet, but it had no increase in capital income. So interestingly, so that was invested capital that generated no return. So they made a significant investment, and the result was they actually lowered the return on equity of the club because it was a ill-advised investment. Doesn't mean every investment is gonna generate more capital income, but if you're making a significant investment, you really ought to ask the question, can we tie this, to increase capital income? Is that part of the plan, increasing our capital income? And just very quickly before we wrap it up, this is there's a lot of discussion these days. I do that CMAA conference Chautauqua bike ride, and there was literally an email that just went out a couple weeks ago around, we're looking at building a fitness center, and what does it mean to clubs that build fitness centers, and diverse amenity. We're a golf club now, and so I had this chart that I put together a few months back, and just very quickly, green, as yellow slice grows, just think of it, it means you're becoming a more and more diverse amenity club. So here tends to be a golf-only club, and here's a very diverse club where they've got lots of pool, tennis, fitness, and so their course maintenance spending is now equal to their non-golf sports spending operationally, not a capital, but operationally. So more and more of their operational spend goes beyond golf. And let's look at what happens to those clubs, just a couple data points. First of all, let's look at the member counts of those clubs. Now, that makes sense because if you have only a golf club or a golf club and maybe just a pool or whatever it is, there's only so many members you can cram into that amenity at the same time. You're self-limited on your member count. As your amenity set becomes more and more broad and diverse, it's like it's like a ski lift, a ski mountain that has lots of different lifts and different mountains, right? You can spread them around to use different parts of the facility. No different than a golf club. So that's one aspect that's important. The other is, let's look at the initiation fee medians for each one of these groups of clubs. 14,000, 24,000, they don't change in the middle here, 57,000.
Yeah.
So that's the best case for the marketplace saying loud and clear, we place high value, this is real, it's a snapshot of 2015, we place higher value on our investment to become a member at a highly diverse club, than we do at a less diverse club, meaning for amenities. Now that doesn't mean that you can't have a very, very high-end exclusive golf-only club where they get $100,000 to join, right? You can still have that, but I'm talking about the middle of the industry and how the bulk of clubs operate. So that's an interesting facet. In terms of how you create value, it can be done a whole number of different ways. It doesn't have to be a $5 million project. It can be things like food trucks. It can be things like a big renovation. It can be just sending your culinary team to some really off the charts training and get ramp up the whole again, food and beverage as an amenity perspective, not as a profit center perspective. You have the poster children for people that live in that green circle. Union League affiliate, I'm sure you all know, right? They were nearly bankrupt 10, 15 years ago. Now they've got an ROE that's between 25 and 30%. It's off the charts. They added a restaurant down at the Jersey Shore because their members spend time at the beach. They just bought a golf club, so now Union League affiliate has a golf club that their members can go golf at, and they've seen their capital income grow. So there's lots of different ways you can. Every club ultimately has to decide for themselves how they get there. The punchline is, if you think you're in that cost-cutting culture, maybe you're not in the decay cycle, but you're leaning more towards that cycle versus the growth cycle. It does take some bold moves, and this is strategic board discussion, right? This isn't the GM coming back in and saying, "Hey guys, I know what we should do," right? Nothing's that simple. This is education. But you want to create momentum, right? Investment has a momentum cycle to it, right? Investment spurs success, spurs investment, on and on and on and on. They don't always need to be large, and every club ultimately has to decide, what they spend money on, and my thought on that is just gearing it towards member value. Does it have direct member value? That's the mantra, because you'd think that would be self-policing, but it's not. People invest on things that, as I mentioned, aren't always the most investment value, and you can measure it. If you're making effective investments in the club, there should be increased capital income, right? If you're creating either demand from new members or adding to the asset base such that your members have more things that they need to be supported from their capital dollars, you should see increased capital income, which keeps you in that cycle. So I won't go through this again because we've already been through that. But capital is the engine to at least kind of put in the gas tank to be on this side. Without that capital-rich, or at least improving engine, it's very hard to get into that notion of value creation. So just a couple parting thoughts. The opportunity for value creation, none of us are anointed to it, but it does live at the intersection of culture and finances. And it takes some strategic intent to recognize that this whole notion of value creation and return on equity and increasing capital income, those discussions need to be brought together as a very long-term forward-looking view for the club. We saw we can gauge it, right? If you can measure it literally, just like you go on, if you're thinking about investing in a company, you can go on today to Yahoo Finance and look at the return on equity value for Microsoft, and look at across 10 different software companies and say, you know what, I'm gonna buy the stock of the company that has the highest ROE, right? There's no reason that clubs can't operate the same way, at least, knowing how to start to make those measures. Is your club physically growing or shrinking, right? That's the unrestricted net assets. Everyone should do that 5-year chart, and it should be a boardroom discussion, because if it's growing, you should understand that it's growing, why it's growing, and it's growing with intent. If it's shrinking, as a lot of clubs are, that's a real discussion that needs to be had. And ultimately, that investment is the on-ramp for that growth cycle. It's not easy to get on that. It takes bold leadership in the boardroom and with the membership to get onto that on-ramp. But we know the K cycle and the cost-cutting culture is not that fun of a place to be. And I do believe no matter where a club is, it can move up and to the right on growing your unrestricted net assets and on increasing your capital income. I guess simply stated, investment precedes success, and you have to break that decay cycle by investing. But as we talked about, investing wisely. So I apologize. I did go a little bit late, and I apologize for the rough start on the webinar. I do have your code word, and it pains someone who lives in New Hampshire. I came up with the code word, but it pains me. The code word that you need to send to Susan to get your activity credit is Go Seahawks. And you guys did a good job on Detroit. And who knows? Maybe my beloved. I was going to put Go Pats as the code word, but I didn't think that would go over too well. So who knows? Maybe we'll see each other in the Super Bowl. But I wish you guys good luck. And if there are any questions, I'm happy to take questions. Terry, I don't know if any chat came in or if you want to unmute anybody, but I'm happy to take questions.
I don't see anything in the chat pane. If anybody has a question and wants to unmute themselves, or you can grab that email address off the last screen there and send those to Russ. Is there anybody that has anything? Maria says, hi, Russ. I'm not seeing any questions come in. Okay, so how soon might we be able to get a copy of the recording? As soon as we stop, I'll get it uploaded. Probably should have it sometime in the morning tomorrow. And I'll get that to Susan. I think Susan's planning to post it on the Evergreen website, and then it'll also be in our library.
Okay, great. Well, I appreciate everybody's time today. And again, we're going to try that roundtable discussion. That will be absolutely a discussion as opposed to a presentation. It's on the 19th at 1 p.m. So, feel free to talk to Susan about getting involved in that. And with that, we'll see you all soon.